You think $330 trillion in global debt is bad? What if I told you the real danger isn't the debt we can see, but the companies that should already be dead, yet somehow just won't die? Well, these zombie companies are quietly infecting the entire global economy. They're draining growth, distorting markets, and you guessed it, setting up the next big financial crisis. Okay, let's dive right in.
All right, so to really understand this threat, we first have to know what we're looking for. What exactly is a zombie company?
So here's the official kind of clinical definition, but don't let the jargon fool you. An interest coverage ratio below 1. Well, that's just a fancy way of saying the company isn't making enough profit to even cover the interest payments on its loans. I mean, think about that for a second. They have to take on new debt just to pay the interest on their old debt. It's a financial treadmill to nowhere. They are, quite literally, the walking dead of the corporate world.
Now, these zombies didn't just pop up overnight. As you can see from this timeline, they were really created in waves over the last 15 years or so. First, you had the 2008 financial crisis, which brought interest rates down to basically zero, the perfect breeding ground. Then, we had an entire decade of cheap money that allowed them to multiply like crazy. And finally, the massive pandemic stimulus that unleashed the biggest wave of them all.
And make no mistake about it, this is not some small niche problem. Zombies are absolutely everywhere. I mean, look at Japan. An astonishing 17% of their listed firms qualify. In the US, it's over 12%. We're not talking about a handful of struggling businesses on the fringe here. We're talking about a systemic infection right at the heart of the global economy.
So what's the big deal, right? Why should we care? Well, let's look at how these companies drain the very lifeblood from a healthy economy. Economists have a pretty dry term for this damage: resource misallocation. But the idea behind it is simple. Zombies take things that should be going to healthy companies. It happens in three main ways. First, they crowd out credit, just sucking up all the available loans. Second, they cause labor congestion, which means they're hoarding skilled workers in these dead-end jobs. And third, they suppress the market, using their debt to slash prices and basically kill off the healthy competition. You got to remember, every dollar, every engineer, every single loan that's trapped inside a zombie is a resource that can't be used to actually build the future.
And this impact, it is very real and totally measurable. Data from the OECD shows that for every 1% increase in the number of zombie firms in any given industry, the overall productivity in that whole sector falls by 0.3%. That is a direct, quantifiable drag on economic growth year after year after year.
Okay, now here's where things get really, really weird. You'd probably think these super inefficient companies would just cause prices to go up, wouldn't you? But it's actually a paradox. By keeping way too many factors running, they actually push down the prices of physical goods. But at the very same time, by hoarding workers they can't really afford, they help inflate wages in the service sector. And the end result for us? This strange, distorted inflation that just means higher living costs for you.
So let's connect all this back to that massive number we started with, the $330 trillion in global debt. How in the world do zombies fit into that picture?
If you happen to catch our explainer on the $330 trillion global debt bomb, you might remember we asked a really important question. How did the world drown in debt so fast? Well, this is the missing piece of that puzzle. See, zombie companies aren't just a symptom of the debt crisis, they are a key engine that's actively driving it.
It becomes this really nasty, vicious cycle. Zombies need cheap debt to stay alive, so central banks keep interest rates super low to prevent a massive wave of bankruptcies. But all that easy money inflates the global debt bubble even more. And in the process, it creates even more zombies. The so-called solution to the last crisis literally becomes the fuel for the next one.
And the sheer scale of this is just staggering. We're talking about an estimated $15 to $25 trillion of corporate debt that exists pretty much just to keep these zombie firms on life support. So here's the crucial point. Zombies don't just use that, they multiply it across the entire financial system.
And that brings us to today. We are now entering the danger zone. The era of cheap money is over, and rising interest rates are about to expose who's truly alive and who's just been pretending all this time.
So what happens when all that cheap debt finally runs out and these companies can't refinance their loans? I mean, this isn't some theoretical question anymore. In Europe alone, over $500 billion in corporate debt came due in just the first half of 2024. The reckoning is happening as we speak.
You see, the failure of one big zombie company doesn't happen in a vacuum. No, it triggers a contagion cascade. Banks start taking huge losses, which makes them stop lending. Suppliers don't get paid, so they go under. The bond market panics, which raises borrowing costs for everybody. Mass layoffs follow, and then suddenly global growth just hits a brick wall.
And this infection, it's not spread out evenly. Some sectors are in critical condition. China's local government financing vehicles, for instance, are a massive hidden risk. Commercial real estate, both in the US and in Europe, is under immense pressure. And these really capital-intensive sectors like mining and telecom, they are packed with companies just living on the edge.
So, the big question is, how do we get out of this mess? And maybe more importantly for you, how can you protect yourself from the fallout?
Well, there's no magic bullet here, I'm afraid. The solutions require some really tough policy choices. We need stronger bankruptcy laws, and banks have got to be forced to stop evergreening. That's the practice of just pretending bad loans are still good. Ultimately, we have to let unviable companies fail. It's a process called creative destruction. Out with the old, inefficient businesses to make way for the new and innovative. Yeah, it's painful in the short term, but it's absolutely essential for long-term economic health.
Now, for any investors watching, this slide is basically your survival guide. These are the key red flags to look for. We've already talked about the interest coverage ratio. Next up is free cash flow to debt. Is the company just burning more cash than it's bringing in, relative to its loans? Then you've got net debt to EBITDA. Is its debt load more than 6 times its earnings? And finally, the Altman Z-score, a classic bankruptcy predictor. A score below 1.1 is a major warning. If you see these signs, you should probably stay far away.
And to really wrap your head around the scale of this whole thing, you have to see the system these zombies are feeding on. Our 330T explainer breaks down that global debt monster. Watching it will really help connect the dots and show you the full scope of this risk.
This all brings us to the single most important takeaway of this whole breakdown. The real danger isn't just the size of global debt, it's the weak, unproductive companies hiding inside of it. You see, zombies aren't just a symptom of the debt crisis, they are the trigger for the next one.
And that leaves us with one final, pretty chilling question. If interest rates stay where they are we about to witness the great zombie apocalypse that policymakers have spent 15 years trying to prevent? The next 2 to 3 years, well, they're going to tell the tale.
If you found this deep dive into the hidden risks lurking in our economy useful, be sure to subscribe for more breakdowns just like this one. And if you want to support our independent research, you can always buy us a coffee. The link is right there in the description below. Thanks for watching.